Let's start with the big picture, a macroeconomic and top-down fundamental analysis. Right now, we're seeing a clear policy divergence between two of the world's most influential central banks, the European Central Bank and the Federal Reserve. The Fed remains firmly hawkish, maintaining elevated interest rates in an effort to curb sticky inflation. Meanwhile, the ECB is leaning dovish as growth momentum in the Eurozone starts to soften. This divergence creates a significant macro imbalance, and in general, it favors the euro while putting added pressure on the US dollar. Supporting this, the US dollar index, DXY, has started to weaken, signaling broader downward pressure on the greenback. Looking ahead, several key events are on the radar. The FOMC meeting minutes on June 18th, US CPI data on June 21st, and German business sentiment reports. All of these have the potential to trigger short-term volatility. So, in summary, from a macro perspective, EURUSD carries a bullish bias for the midterm. However, short-term movements could be choppy as markets digest upcoming data releases. Now let's dive into smart money behavior, one of the key concepts used by professional traders to track the moves of large institutions. On the H4 timeframe, the market structure clearly leans bullish. We've seen a break of structure to the upside, with price forming a series of higher highs and higher lows. Most notably, price bounced with precision off a bullish order block zone around 1.1450 to 1.1470. That's no coincidence. This is a strong signal that smart money is active in that area. Shifting to the H1 chart, a change of character, choch, has been confirmed, indicating a shift in momentum from bearish to bullish. Shortly after, we also get a minor boss, adding further confirmation that price is ready to push higher. CVD data supports this narrative as well. CVD is starting to turn upward, signaling that buying volume is beginning to dominate the flow. In summary, it appears smart money is in accumulation mode. The bullish reaction from the order block zone acts as a strong confirmation that their intention is to drive prices higher. Now let's dive into intermarket analysis, where we look beyond just currency charts to understand the broader financial landscape. The yield differential is telling the story. US 10-year Treasury yields are starting to fall, now around 4.2%, while German bond yields remain steady at approximately 2.5%. This narrowing gap reduces the yield advantage of holding dollars and naturally favors the euro. Meanwhile, equity markets are echoing the same tone. European stock indices are currently outperforming their US counterparts. This suggests capital rotation. Investors are moving money into euro-denominated assets, which adds buying pressure to the euro itself. The takeaway? EUR strength isn't just a chart pattern, it's fundamentally supported by bond spreads and equity capital flows. Now let's talk numbers. This is where quantitative and statistical models give us extra confidence in the trade. Recent machine learning models analyzing EURUSD volatility, skewness, and momentum indicators show a probability tilt toward upside continuation, especially when RSI stays above the 50 level and price holds above the 200 EMA on H1 and H4. Historical mean reversion models also support the idea that EURUSD may continue climbing toward the upper boundary of its recent distribution, especially given the DXY's current deviation below its 30-day mean. In short, the math checks out. When sentiment, structure, and statistics all align, momentum is rarely accidental. Next, we turn to trader sentiment and positioning. What are the masses doing, and more importantly, what are the institutions planning? Retail trader data shows a heavy short bias on EURUSD, often a contrarian signal. Meanwhile, institutional flow data and commitment of traders reports reveal net long positions increasing among non-commercial traders, those who typically move the market. Translation: while the crowd is selling, the pros are quietly accumulating. That divergence often signals a breakout is brewing. Now let's dive into what the machines are saying, because in today's market, algorithms read the news before we even finish the headline. Natural language processing, NLP, models analyzing thousands of financial news articles and tweets indicate a positive sentiment bias toward the euro, especially after dovish signals from the ECB were largely priced in and attention shifted to persistent inflation risks in the US. Keywords like rate pause, stagflation concerns, and Eurozone stability are trending across news feeds, while the USD is associated with policy lag and market uncertainty. What does this mean? The sentiment momentum is tilting in favor of euro strength. When sentiment, tone, and macro align, it can act as a powerful tailwind for price. Now let's look at the options market, where we find another powerful signal. Risk reversals, which measure the demand difference between call and put options, are now skewed in favor of calls. Translation: traders are paying a premium to bet on EURUSD going higher. And this isn't just a short-term play. The 1-month and 1-year risk reversals both show that calls are more expensive than puts, meaning smart players want exposure to euro upside and protection from dollar downside. On top of that, the implied volatility structure is leaning bullish, indicating that traders expect movement and they expect it upward. What does this tell us? Market makers and institutions are bullish under the surface, and they're showing it by putting their money where their mouth is.
While we can't show you a live bookmap chart here, we can infer a lot just by looking at how price behaved around 1.1450 to 1.1470, a textbook bullish order block. Here's what likely happened. There was a liquidity sweep right before the bounce. Classic smart money play. Large resting buy orders absorbed the selling pressure in that zone. After the bounce, new liquidity began forming higher up, likely around 1.1550 or more. This is exactly how institutions engineer entries. They don't chase price. They create traps, sweep liquidity, and buy into weakness. Bottom line, that bounce wasn't random. It was absorption in action, a high-probability footprint left by smart money accumulation. Lastly, let's look at macro momentum that many traders overlook, the Economic Surprise Index. This index tracks whether recent economic data beats or misses expectations. Right now, the Eurozone's index is improving, while the US index is flat or declining. That means Eurozone data is surprising to the upside, while US data is falling short. Why does that matter? Because positive surprises build confidence, attract capital, and fuel currency strength. So what does this mean for EURUSD? The market isn't just reacting to headlines, it's reacting to consistent positive momentum in euro area data, and that gives real reason to hold long EUR positions over time.
Finally, let's anchor all this with a solid technical foundation based on your chart visuals. On the H4 chart, we clearly see a strong bullish BOS or break of structure, formation of higher highs and higher lows, and a confirmed order block around 1.1450 to 1.1470, which price has respected, suggesting institutional interest. The H1 chart reveals a recent COCH or change of character from bearish to bullish follow-through with minor BOS. CVD turning positive or volume flow confirms the bullish transition. EMA readings on both timeframes confirm trend alignment, and indicators like RSI and stock are in supportive zones. With multi-timeframe structure bullish, positive order flow, strong macro alignment, and supportive sentiment, the bias is clearly to the upside. Final trade plan, bias bullish Euro USD. Entry area retest of OB zone 1.1450 to 1.1470. Confirmation, only enter if price holds above 1.1450 with volume support and RSI greater than 50. Stop loss below 1.1420, structure invalidation. Target 1, 1.1550, target 2, 1.1620, extended move if DXY continues to drop.